Hey everyone, welcome back to Premier Study and Investing. It's great to have you. Hope you guys are having a good week or a good weekend, wherever you are, whatever you're doing. Thanks for stopping by. So previously I've done videos on how to build an optimized stock portfolio, how to basically get the risk-adjusted returns and all this stuff. For those of you that are in finance, you might have come across these terms, arithmetic returns versus log returns, natural log returns. And I want to go through a couple examples. I recently referenced this in a value at risk video that I did just last week or so, basically trying to help us estimate what is the potential losses that we could face. And so that used log returns, as you can see here in the column F. So I wanted to walk through this really simply so that you're not so confused if you come across these things and you can't exactly understand why are we using these. So let's jump in. First, let's start. I'm going to have a number of periods here, period 1 through 12, and I'll make this more complicated as we go, but let's start simple. I have a stock that's worth $100 in period 1. It goes to $120. Most of us would say we just gained 20 bucks on a $100 investment. We got a 20% return. Yeah, that's right. That makes perfect sense. This is just the blue divided by the red minus 1. No problem. 20% return. Exactly like it says. If we use the natural log formula, which is equal sign ln, open parentheses, the blue divided by the red, close parentheses, it will give us a return of 18.2%. And I was thinking about white man can't jump. And Billy's girlfriend that would say,
you should have said I love you infinity plus infinity.
We all know that there's no way if you gain 20 bucks on a $100 investment. How in the world are we going to say you got 18.2%? It's okay. We're going to understand the value of LN returns, but as a jumping off point, let's just first start out by saying that one of the aspects about log returns is that they're irrational. We'll have another irrational in the sense that they're difficult to grasp mentally. I mean, another term that you could use for log returns is continuous compounding. And we just don't talk in those terms, you know. It's just not very common that we would say, oh, I got an 18.2% continuously compounded return over the last month. No one talks like that, you know. Everyone says 20%. You make 20 bucks on a $100 investment, you make 20%. Well, let's look at some of the advantages of LN returns and some of the drawbacks of arithmetic. Let's go one more period here. Let's say our price falls back to the $100 that we started at. Well, if we use the same formula, the blue one divided by the red one minus 1, the arithmetic return would tell us that we lost 16.67% in order to get back to 100 bucks. Now, we might be tempted to say, well, I gained 20% and I lost 16.67%. This is our first return, this is our second return. So we have two returns. So we'll take the 20% return minus the 16.67% return, leaves us 3.33%. And since I did it over 2 periods, I want to get a monthly return, I'll divide by 2. That means I got a 1.665% return. No, I didn't. I started at 100 bucks. I went to 120 bucks. I'm right back to where I started. I did not gain 1.67% on average. That's what we did. We did the average. We divided by 2, right? Simple math, simple 4th, 5th grade math. I don't know what that is. Okay, so this is one of the things about arithmetic returns. It's very confusing. You can't combine them in the simple sense that we like to say, you know, I earned, you know, so much on Tuesday plus so much on Wednesday with my side job, so I'll just add them together. You cannot do that with returns, as we can see here. Plus 20 minus 16.7 leaves us with a positive number. In real dollars, we know we didn't gain a dime. Okay, so check this out. Look at LN returns. Now this is the cool thing about LN returns, or log returns, natural log returns. We gained 18.2% in the beginning, first period. Second period, we lost the exact same amount. Total return is a goose egg, right? If you combine those, which is exactly what we know intuitively to be true. We have gained no money, even though time has passed, 2 months have passed. Okay, you with me so far? Interesting. Now, one of the reasons I got into this and why I wanted to look at this a little bit more closely is because in this portfolio, building a stock portfolio video that I did, it was very long. And I advised you guys to use this method. I did not talk about this. I said, you know, figure out the month over month arithmetic returns. This is what I told you to do. And then I told you to do this. Let me get this out of here. I said do this formula. Equal sign, sum product, ODUCT, open parentheses, geomean, GEOMEAN, open parentheses again, highlight the returns that I'm interested in getting my average for. I want the 20% and the 16.67% that's negative. I am going to also add 1 because that's how we do geometric. We add 1 to each return, and then that's how we get the geometric average. You guys probably are aware of that. We're going to put double close parentheses to close out that, and we're going to subtract off our 1 that we just added so it doesn't mess everything up. And this should give us a 0% return, exactly like we see in our prices, and exactly like the LN returns would give us. And thankfully, I didn't mistype anything. That's exactly right. 0% return, just like we saw in our prices, and that we know intuitively. So if you ever get confused when you're looking at these things for log returns, arithmetic returns, geometric averages, it's easy to get confused. There's a lot of terms. I even saw some papers as I was looking at this where people, they say not everyone uses the right terms or the same terms. And so even people that grasp what's going on can screw it up and misspeak, or especially to newer people, confuse the snot out of us, right? We're like, what are you talking about? So that's really, really interesting. So this is cool. We have the 0% return, average return here. This is very obvious. Because the cool thing about LN returns is that they are additive. And that's one of the great things why people like log returns. It's not the only reason they like them, but it is one of the reasons that they like them. You can just add up the return I got in the first period, plus the return I got in the second period, plus third, fourth, fifth, sixth, you can go on. And if I move this little bracket thing that I have here, it's very nice, right? I mean, it's much easier just to add two things together than punch out all this stuff that I said. Equal sign, sum product, open parentheses, geomean, open parentheses, my array, plus 1, close parentheses, minus 1. I mean, that's a lot more work, right? It's a lot easier to mess it up. Anyways, there's also a pretty easy way to go from log returns back to simple returns, or what they would call arithmetic returns. Now, let's move on a couple more things. Let's say that we had a big price increase. So we were at 100, then 120, then 100, then 9. Well, look at this. This is really interesting. The arithmetic return would be 800%, very big number. And the log return would be something quite smaller, 220%. So this makes sense. We could kind of grasp that. Okay, it grew 8 times. Okay. But this, 220? What's 220? Okay, let me give you one more example here. What about if the stock price goes from 900 and it drops down to 300? Okay, well, in arithmetic returns, we lost 2/3, right? We lost 66% of our money. Yeah, totally, no problem there. It makes perfect sense. What if I go over and look at the log returns? Minus 110. And you might think to yourself, wait, hold on. How can I lose 100% of my money holding stocks? I mean, I can't lose more than what I put in. I mean, if I invest $500 and my stocks go to 0, I lost 100%. That's the maximum loss I can have. How can I lose 110%? And that doesn't make any sense right either. That confuses us when we see 110% loss. I mean, you might think, oh, what did I do wrong? What's wrong with these numbers? What's the holdup here? Well, that's why we're looking at it. Now, one thing I did is I picked these prices, and you can see I made it 12 periods. So we'll say 12 monthly returns, which is nice. I'll put this back over here. I picked some numbers, since I look a lot on this channel at stock returns for biopharmaceutical companies, especially say like health therapy companies or vaccine companies. If you take these and divide them by 100, this is kind of like the Sorrento stock or Altimmune stock, or many of these pharmaceutical stocks, right? Early in 2020, they were trading at $1.20, maybe back down to $1. Then they had a huge spike in say April, May, June, July, maybe August, up to $9, hit a peak, then fell off a cliff, back down to $3, up to $5, oh, down to $4, back up to $5, oh, down to $3, ugh. Back up to $5, okay, down to $4, ugh, okay, down to $3, ugh. What's going on? This is very similar to what we see in these stocks all the time. And so we have these pretty huge swings. Plus 20%, minus 16%, up 800%, lose 2/3 of my money, gain 2/3 of my money, lose 20% of that, up 25%. There's a lot of volatility in these stocks. So what is really interesting is if we go down here, we can come up with 2 different types of averages. Now, what I told you guys to do in that video on building a optimized stock portfolio is to first find your arithmetic returns and take the geometric average of your monthly returns, which is exactly the same thing that I did right here. And you can see that this formula in the formula bar is exactly what I posted right here. Equal sign sum product, open geomean, open the range, plus 1, close, minus 1, and you can do it that way. You can also do it the more traditional way that they teach in the textbooks, which is basically taking the product of all of our returns, all these returns, adding 1 to each one. So it'd be like 1.2, this one would be like, this is a weird number, 9, but like this one would be 1.667, right? We see this all the time. The red ones you have to subtract, but you multiply all those together, and then you raise it to the power of fraction 1 divided by 11 in pink, 11, the number of periods you have minus 1. Why minus 1? Minus 1 because we don't have any return in that after that first period. I don't get my first return until my money's been in there for a full month, right? And then I see I get my 20%. There's no return in the beginning. So 11 periods, which is the fraction of the exponent 1 over 11. And then again, once we get done calculating all that, you subtract the 1 off. Now the really interesting thing is that you'll see we can do that and get the about 10 point, we'll put these in percents, 11%, 11.503%. Now, if we add up, the cool thing, like we said, we can add up the log returns that we have here. We can add them up. So take all these, the blue, sum them here in this box, and then come over here and divide by the number of returns. Well, I have 11 returns. I have this one, this one, this one, this one, this one. I have 11. That's why I put it in pink. So you'll see the pink, and the pink. Okay, the 11s are important. And we'll see that this actually gives me a different monthly log return. Now, not terribly different, but about half a percentage point off. Again, I'll put this in percentages for you. Move it out 3 decimal places. And you can see this is right at almost 10%, and this is about 10.5%. So, this is another weird thing. Which one is better? One thing that I've read, and I'll continue to look at this, but you'd like to use these if you're forecasting. Okay, if you are modeling future stock prices or something like that. What we were doing is using historical data, and we were basically looking at the historical returns, and we were looking at this historical volatility. We use those numbers, these arithmetic returns, to find our geometric average return for our stocks. We put those into an annual form, and then we did the same thing for the standard deviation. So it was very interesting. One thing I'd like to point out, if you're talking about, if you move on to standard deviation, is this right here. When we jumped from $100 a share to $900 a share, the arithmetic change is very, very big. 800% change. Here, only 220. So one thing that has caught my attention, I'll continue to look at, or if you're more familiar with this from a statistical background, if you have that, maybe help us out, comments. I'm certainly going to keep working on it as I progress. But an 800% jump is a much more volatile jump than a 200% jump, right? Meaning that these numbers pretty much are always smaller. You could see that when we're talking about volatility. We don't have these crazy, crazy spikes. Plus 800, minus, I guess, 40%. Well, it's interesting. This is minus 51%. Some interesting comparisons. Anyways, moving on, I just thought I'd do a couple more things. I did do the sample standard deviation for these returns. It was about 2.45. If I take the sample standard deviation for these returns, the log returns, it's much smaller, 0.83. And the interesting thing is if you go to calculate a Sharpe ratio, which is your average returns divided by your standard deviation, you're going to get pretty different numbers. Now, I will apologize in the sense that I'm not quite at the place where I can totally interpret these for you guys, but I do at least want to point it out, and we'll keep working on it as we go. If you're a finance student or if you're an investor and you use these types of tools to understand what's going on with your money, something to keep in mind. I'm still progressing through the CFA program, and I'm going to be doing portfolio management here in a couple weeks, and so hopefully I'll be able to shed some more light. Let's go down here and do one more really interesting thing. Let's say, get this out of my way. Let's say we did a very simple example. And again, we're trying to understand the difference between arithmetic and log returns. Well, one thing, I did something very simple. I put a rate of return of 1.1, which is equal to 10%. Okay, that's what, it'll be my rate of return factor. I'll be multiplying. So like $100, my $100 times my 1.1 will give me my $110 here, my 10% gain. I'm doing a 10% gain at every point. I'm at 121, 133.1, 146.41, 161.51. I'm just compounding monthly at 10%. And we see that very easily here. It's very clear when it comes to arithmetic returns. 121 divided by 110 minus 1, 10%. And, go figure, if you have 10% at every period, the average that you're going to have is 10%. I like that. That is really nice to understand. What's going on over here? A 9.531 average monthly log return. Very interesting, right? So if you get confused, don't beat yourself up for it. I mean, it is confusing. These are intuitive. Arithmetic returns, these are pretty intuitive. These not so much. Why do people like these? They especially like them. I'll look at an article here just in a second. But so what they essentially do is they add these together. They get these numbers, and then they convert it back at the end back to arithmetic returns if they want to do a report or something for investors to understand what happened with their money. There was one interesting thing that you will notice, this difference that we had. Here we had an average return of 10%, 10% in every period. Yep. And here we had same thing, same average, but 9.53% return. We had a difference of about 0.46%. As we increase the rate of return, so say we got a 25% rate of return, watch this number. This number is going to jump as far as the difference between the two measures. Now we're at a difference of 2.68%. The further that I increase and make this a larger return, if I do 39% annual return, now the difference between my two measures is 6.069%. And you could just go on and on, especially with very volatile stocks. We had a very volatile year. You could be looking at certain measures where, how many companies, I don't know, had great returns. Let's just say from the bottoms of the 2020 crash, S&P 500 was up almost 61%, something like this. Well, that'd be arithmetic return 60%, log return 47%, a difference of almost 13%, right? Very, very, very interesting stuff we are talking about here. Let me read this to you. This is essentially the difference that you're starting to see, this convexity, this greater, as you can see, this is 0%, 20%, 40%, 60%. When you compare these two different returns, the larger that the measurement is that you're using, the more volatile your stocks are, you could say. You're seeing a growing gap here in this. This is the difference between the two measures we're looking at. Right? And you could saw, we just did 60%, and we saw that it had a difference of, 13 percentage points by the time you get all the way out here. So that's pretty big. That's really big. This is what I was referring to. If one is modeling the stock market, it's common to assume that returns are normally distributed. Now, I don't know why they're making this assumption completely. I understand that it's a lot easier if you want to do like we did in that video for expected losses or value at risk. It's much easier if you can just assume that everything is log distributed, or normally distributed, normally distributed. But they say in this context, log returns are far superior to arithmetic returns since the sum of repeated samples from a normal distribution is normally distributed. So I don't want to take a ton of time to explain what they're talking about, but what they're basically saying is that if you have, this is bad, I know this is not like the, forgive me, normal distribution, right, where you have your first, your second, and your third standard deviations, and you have those on both sides. If things are normally distributed, we know how everything works. We know what this is from here to here, we know what this is from here to here, and we know what this is from here to here. And a lot of things in nature are normally distributed. Like grades are often normally distributed with a class. You have, high performers. You have kind of the middle of the pack where most people fall, and you have the people that are really struggling. What they're saying is if you have a sample, and then you take like a ton of different samples, so you take one sample, then you take another, and that's normally distributed, and then this one's 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 normally distributed. That you can basically take here you're going to have a mean, like an average, right? In all these, where, say, most of the people fall. Then you can take all these. You can take this mean, and 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 you can add them all up, and you can divide by. But in order to do this, you have to have normally distributed samples. Well, that's why they like log returns, because so they say that it's very important to get these normally distributed graphs in order to get these means. And if you can get all the means, then you can add them all up, and you can divide by 5 or however many you have, and then get like an average of your averages. Okay, it doesn't work if it's not normally distributed. And arithmetic returns are not normally distributed, but these are. So, that's kind of some of the other things they say. However, it's not to say that arithmetic returns aren't without their benefits. Arithmetic returns aggregate well across portfolios. The arithmetic return for a portfolio is simply equal to the weighted average of each constituent's arithmetic return. What does that mean? So what they're saying is instead of, let's just forget that we have these periods and these prices here. Let's get rid of that. Let's get that out of our mind. Let's assume this is the return we got on Amazon. This is what we got on Intel. Let's say this is what we got on Tesla. Let's say this is what we got on Merrick. Let's say, and these are all of your returns by your different stocks. If you want to get an average return for your portfolio, all you have to do is say, okay, how much money do I have invested in Amazon? How much do I have in, Intel? How much do I have in Tesla, right? If I have 10% of my money in Tesla and I got an 800% return, then you get like a weighted average for that. So it's the percentage of my total money times the return I got on this gives me this. And then you can just add all those up, and it's very nice. You can't do that with these returns. So that's what was helpful for us in the other video we were doing. What else do they have to say? Here's a couple other things that people like about log returns. They say it's very easy to convert back to simple returns or like arithmetic returns, same thing. Simply by, this is a fairly simple formula. It's not that difficult, and especially if you're using Excel, it's not that many characters. So it's not that hard to switch back and forth from one to the other. So they kind of like it for that reason. Also, let's see what they have to say about these normal distribution. It says, in the realm of asset pricing, stock prices are assumed to follow log normal distributions. So log normal distribution has some kind of thing like this where it's kind of like so with the longer tail on the right side. Smooth all that out. But what they're saying is they like how it has a zero boundary. So you cannot go below 0. This is 0 here. And then these are increasing. So they like it for that reason because it, like we said before, how can I lose 125% of my stock investment? The lowest I can go is down to 0, right? So they like using the normality and doing log normal returns, which fit another graph that they're very familiar with about how, what's the slope of the line at every point, and, how can you use it to estimate certain things. It's a standardized graph, I guess is what I'm trying to say. So it says, note that this is an approximation and not necessarily reflective of the actual distribution, but a log normal distribution gives the desirable property to ensure that the stock prices never go below 0. Stock price also seems to move in an exponential way over time. In addition, if the prices are log normally distributed, that's this, ln, log normal, then it follows that the log of its prices will have normal distribution. And we know that log returns can be expressed in terms of stock prices. See the equation below. So log returns are normally distributed. The other bad thing about log returns is they cannot be added across securities of a portfolio. If you manage a portfolio, you're almost going to have at least a few securities. The simple return of your portfolio over any time period is the weighted sum of all the simple returns from each of the securities. However, you cannot pull the same stunt with log returns. It will give you an erroneous number. Remember that log returns is a continuously compounded rate over time. When you add log returns, you compound. Across different stocks within the same period, there are no compounding elements here. That makes sense. I mean, I don't get extra money on my Amazon stock just because I got some good return on Tesla. They don't, there's no crossover bonus like that. So for computing portfolio returns across contribution from securities within the same time period, use simple returns instead. Anyways, that was probably too long of a video, but the thing I really wanted you guys to know about, and that was very helpful for me, is if we use this sum product function with arithmetic returns, it will not give us the wrong average return. It will give us 0, just as we know intuitively. $100 up to $120, down to $100 is a 0% return. And we can, if we use the right formula, still use our arithmetic returns and end up with the right number. We can also do that with log returns, as we saw here. You just sum these two together. Positive 18.2% plus a negative 18.2% is also going to give us 0. The point is that you are not required to use log returns as long as you're able to use the sum product, open parentheses, geomean, open parentheses, the array plus 1, double close parentheses, minus 1. Okay, so that was a big sigh of relief for me because I did not want to confuse you all. And as I was looking at it initially, I thought, you know what? These averages are not totally different, but they are off by almost 0.5%. And that worried me. I didn't want that to affect you guys negatively in a bad way, as well as for me. Again, I mean, I'm not doing stock market advice. If you want someone to do this 100% perfect, hire a true professional. I'm just making these YouTube videos and trying to help you guys do it yourself and learn a little bit as we go. I'm still a student of this, so, forgive me, bear with me. But like I said, the other thing that I thought was really important also to notice is that the standard deviation were quite different. 2.45 versus 0.83. Very, very different. And then also Sharpe ratios were pretty different. Now that doesn't mean that you might not be able to use the log returns to get your average, and then apply your different standard deviation, and then the program would still optimize everything with the same weights in both fashions. I don't know. I mean, I haven't gone and tested that, and it may be true or it may not be. I would be a little bit worried that it would be off. And I don't have the deep math background to go and prove all that. Maybe for another time, another video, we can try to prove that. But it would take quite a bit of work. Well, thanks so much for stopping in, and we will talk to you guys next time. Bye.